Now, I'm going through that specifically, and I really want you to start to understand this and get some perspective when we talk about money management. You know, money management is just that, managing the money that you own, that you control, that you have at your access. In Cool Trade, you've got money in an account with your broker. Cool Trade is not the broker. With your broker, you have an account, there's money in there. So when we talk about money management, it's how you manage that money. Now I'm going to go through the Cool Trade philosophy, and I want to make sure that we understand exactly what that is and how it works. And I'm going to use some case studies here. And I'm going to start with a stock that I know that you're familiar with, Apple. The stock symbol is AAPL. Now here's a chart from 1985 to the present. You know, Apple itself kind of came out to the world, if you will, in 1985. They had a commercial with the Super Bowl, ran just once. Very famous marketing ploy right there. But when you look at that chart, it's very small on the left-hand side, and it's very, very big on the right-hand side. But let's get some perspective. I'm just going to focus in on just one little section right here, around the year 2000. Now, you and I probably remember exactly where you were when the clock struck midnight on the year 2000. I mean, I know where I was, I know what I did. I remember going outside in the backyard, looking around and saying, wow, the lights are still on. You know, they kind of told us everything could go kaput. The lights could go out, disconnection on wires, all your electronics are going to get fried. Nobody knew exactly what was going to happen. So then on the New Year's Day, when the lights were still on, everybody said, wow, the world is okay. But then after that, things started to go downhill later on in the year. But I'm circling that part on the chart. Now let's really zoom in on that. And I want you to get a feel for really what was happening. So this is the same year, 2000, on the screen. It's from 1998 to basically the end of 2001. Right in the middle is that big move down. When you take a look at Apple, it reached over $35 a share during that time, right there in the beginning, the first quarter of the year 2000. And then within a very short period of time, by the end of 2001, it had dropped down to about $5 a share. So it went from $35 a share down to $5 a share. So when you see that little move right there, it looks like just a little blip in the road, but it actually was a very, very severe loss in the value of the stock. Now, it took years and years for that stock to go up. And that's what people don't quite realize. From 1987 to the year 2000, during that period of time right here, 1997 by the way, during that period of time, 3-4 years for it to move up from $5 to the $35, that was a big, huge move. But when it came down very quickly. Now there's something at play here. It takes about 3 to 4 times as long for the stock to go up as it does for it to go down. Now, you know that we can make money when a stock goes down. I'm going to do a training on that next, but I do want you to look at this screenshot right here. It came down in the course of 6 to 9 months. It dropped from $35 right back down to $5. Now that's a massive loss. If you lost 80% of your portfolio in the course of the next 6 to 9 months, how do you feel? What's your emotions? What are you going through? Are you disgusted? Are you in the market? Are you out of the market? Or have you learned from the Cool Trade philosophy that we've taught to have money on the sideline ready to buy that same stock at a quote unquote discount when it's cheaper? Because if you liked it at 35, you're going to like it even more at 20. And if you like it at 20, you got to love it at 10. And by the time it hits 5, you should be buying all you possibly can. Now, Gene, are you telling me that I should just keep buying stock all the way down? What about stocks like Enron? And we can name the names. Well, the reality is you should only be trading stocks with companies that you think are going to be around for the long term. So we're going to come to that. I'm going to go through the whole philosophy, make sure we really have that clear. But let's look at the next little blip. That's this one here. Now this is a little bit farther on. The year is 2009. This is the more recent one that all of us remember. Just spring of 2009, just 4 years ago, what happened there? And I've circled it. Let me blow it up so you can see it clearly. That moved down. This stock went from way up there. It was around $200 a share, and it dropped all the way down here, and it bottomed out at about $80 a share. So again, the year 2008 was around $180, $200 a share, came all the way down to about $80 a share. Now I circled that because you'll notice it struck 80 3 times. It had support, and that's what that's called. It hit that support 3 times, which means it was a lot of support, very, very strong. And then when it came out of that, well, where did it go? Well, that support is over here on the left-hand side of the chart, and then over the course of the next year and 2 and 3 and 4, it marched all the way from $80 up to $700 a share. Another massive move over the course of 3 to 4 years. Now it moved up, and it moved up big, and you can see that there on the left-hand side. $700 a share. It took 3 to 4 years for it to get from 80 to 700. That's a beautiful, massive move, right? But how long did it take for it to come down? Well, it didn't take all that long for it to come down. It came down in the course of about 6 months' time. Now, those 6 months where it went from 700 down to less than 400, that was a big move down. Now, I want you to think that through for just a second. When it came down and it bottomed out there and it was down at 400, this is a time where the rest of the market, most other stocks, were not going down, they were going up. And that's why I wanted to use Apple, because we know the company, we know the products, but the chart itself on these stocks, if we just look at the big picture from 1985 to the year 2013, it just looks kind of like bottom left, top right. But when you look at the specifics, we can see that there were some massive moves on the way down. There were some big moves on the way up. But it takes 3 to 4 times as long to go up as it does to come down. It's very important that we understand these aspects and really get this. But do all stocks recover? I mean, that's the question you really got to ask yourself. Do all stocks recover? Do all portfolios recover? If I'm at 50,000, well, it's going to come back. It's got to come back, because don't all stocks come back? And the reality is no. But even if it did, your portfolio, if it was at 100 and dropped to 50, and 10 years later it's back to 100, the question is, did you lose anything? And I say the answer is absolutely yes. You lost time. And time in the market equates to opportunity. You lost not just time, but you lost opportunity. What could your money have been doing with other stocks, with other indices, making money on the way down for that matter, shorting stocks? You lost time, you lost opportunity. And we see a lot of people at the office at Cool Trade where they come in and they say, can you take a look at what I've done, where I'm at? And as a certified financial planner, I can look at somebody's portfolio and I can say, you've been at the company for 15, 20 years now. How much did you start with? How much did you put in? And it's unfortunate, but a lot of times we see that they've put in more money than what they actually have in the account at this time, even though the market has recovered dramatically. We're at new all-time highs. But they don't even have the money that they put in over the last 15 or 20 years. Now, that's sad, but that's the reality. And that's the fact that most people choose not to look at. But this special report with Cool Trade is all about what happens if and when the market does correct. Because it will happen. It's going to happen. I just don't know when. Whether it's 2 weeks from now, 2 months from now, or 2 years from now, it has to. There's always pullbacks. We're due for a correction. I want you to be prepared, and I want you to know exactly what it's going to look like on your screen.